we're going to get into the second half of Let's Talk Stocks. So we should be on this reading a stock chart portion, and we're going to go through each section individually. So this first one, stock, that's going to be the stock's trading symbol name. That's also called the ticker symbol. So it'll be an abbreviation of the company, letting you know which company it is without having the full explanation. So like we learned on our activity before spring break, you may have seen that Facebook, their ticker symbol or their stock symbol was FB. So it's just a shortened version to let you know which stock you're investing in. Next is the YTD percentage. So this is going to be the year-to-date percentage change. So how has the price changed for that stock since January 1st? Next is going to be the 52-week high and low. So this will be broken down into two parts. So it'll show you both the highest and the lowest prices that the stock has sold within the last year. Those are going to be the first three. Next, we have dividends. So it'll show you the total cash that's been paid to stockholders per share. And this is going to be based on annual payments. So it's not going to be an individual payment. It'll be based on their annual payments thus far. Next, we have the yield percentage. So this is going to be the dividend yield percentage. And it is the percentage of the price per share that has been paid out in dividends. Next, we have the PE ratio, which we just learned how to calculate. So the price earnings ratio is the closing price of the share compared to the annual earning price per share. And then the last four are going to be the Vol 100. So this is going to be the number of transactions to the share that day, represented in hundreds. So how many transactions has the share made in that day? Next, we'll have the high and the low. So this will be the high price for that specific day, as well as the low price for that day. Next is the close, so the price of the last share sold of the day. And then lastly is the net change. So between the closing of today and the closing from yesterday, how did that price change for that stock? All right, and then now we're going to talk about tracking the health of the stock market. So there are three main indexes that track stocks, and they give people the sense of the general health of the economy of the stock market. And these indexes change daily because stocks change daily. So the three main ones are going to be the Dow Jones Industrial Average, and that's the acronym for that is DJIA. We're just going to call it the Dow Jones. The next is the Standard & Poor's 500 Composite Index. The Standard & Poor's is what we worked with in that activity before spring break, so you should be a little bit more familiar with that one. And then the last one is going to be the NASDAQ. So the Dow Jones was originated in 1884, and it is the oldest indicator for the ups and downs of the stock market. So this is the one that has been around the longest in order to track the health of the stock market. It is named after the two founders, and it is the list of the 30 industrial blue chip stocks on the New York Stock Exchange. So it is only the top 30, and it is only industrial blue chip stocks. So they are not going to be having the growth or the emerging stocks on there. They're only exclusively going to be the top blue chip stocks. And so in this picture, you can see some examples of them. So Disney, McDonald's, Walmart, Home Depot, Coca-Cola, those are some of the biggest companies in the world, and they are going to be traded on the Dow Jones. The Standard & Poor's is going to be the largest. They have the activity for 500 stocks. And this is often seen as the most accurate because they evaluate the largest variety of stocks. And so as you can see, some of them overlap. So some companies that were seen on the Dow Jones are also seen here. Coca-Cola, AT&T, IBM, um, McDonald's. They're going to be evaluated both on the Standard & Poor's and the Dow Jones. And then lastly is the NASDAQ. So these focus on the fast-moving, the tech industries, and the financial services stocks. So it covers the market activity for the stocks traded on the NASDAQ. And these are typically the smaller stocks, and they have more speculative stocks than the other two. This causes their readings to have much more dramatic ups and downs than the NASDAQ or than the Standard & Poor's or the Dow Jones. And again, you can see some examples. So they're going to have Netflix, Starbucks, Tesla, eBay, Amazon, a lot of big tech companies, PayPal, and definitely a lot of companies that are in that financial services industry as well. All right, so you may have heard in the past when people talk about the stock market, they may say something about a bull market or a bear market. And that is how we are going to talk about the success of the moment. So the term bull market is going to describe the stock market when prices have risen of at least 20% or more over the period of time that we're looking at. So when it is in a bull market, it means that investors are a little bit more optimistic. Most stocks are increasing. It would be a really great time to be involved in the stock market. This is different from a bear market because the bear market is when the stock market is doing poorly. Investors are typically not confident in the economy at that time. There are more sellers than there are buyers because people want to sell their stocks before they lose any more money. Because there are more sellers, investors usually hold back from purchasing stocks. A bear market is going to be the polar opposite of the bull. It's going to be when there is at least a 20% decline in prices over time. All right. Now we're going to talk about organized exchanges. So companies are evaluated when they are evaluated on the stock market. So there are 5 different ways that we can do this. They will be evaluated on their annual earnings before taxes, on their net assets, their market value, their number of common shares offered to the public, and their number of stockholders holding 100 shares or more. So each exchange only has a number of available seats for brokerage firms who are going to buy and sell stocks on the exchange. And they also have a number of companies that they are willing to work with. So they are going to evaluate the companies who come into, who are basically invited to their stock exchange. If they, reevaluate and you don't meet their standards, they can and will swap companies out for other companies. All right, so the New York Stock Exchange, probably the one that you are most familiar with. This is the Wall Street kind of stock exchange. So this started in 1792. It is the largest stock exchange based on market cap. And they have the strictest company standards in order to be listed. So they are going to be the most strict when evaluating companies that are going to be sold on their stock exchange. This one houses over 2,800 companies, but their market cap was over $12 billion as of 2017. The NASDAQ, like we just talked about, is going to be an electronic stock exchange. So the New York Stock Exchange has people physically in there, centralized. This is going to be an over-the-counter electronic one. They have more than 3,300 small American and foreign companies. So they're going to be a little bit smaller. They're not going to be always the huge companies that the New York Stock Exchange has. They will obviously still evaluate the companies that they are trading, but they are not nearly as strict as the New York Stock Exchange. And then there are going to be regional stock exchanges. So this is going to be a place to trade stocks to investors living in specific geographical areas. They are going to be in larger cities, for example, Boston, Philadelphia, Cincinnati. There are some in the Midwest that do regional stock exchanges outside of the major international stock exchanges. And then there are going to be international. So the stock market works worldwide, and we have some international ones. For example, the CAC, that's going to be the stock exchange in France. The DAX is the stock exchange in Germany, and so on down the list. All right, so how do we purchase on the stock market? The first big thing is that buyers and sellers are meeting to compete for the best price. So we have to rely on the law of supply and demand in order to make the stock market work. So purchasing stocks in the stock market, buyers and sellers meet to compete for the best price, and the market operates on the laws of supply and demand. So the definition of supply is going to be the relationship of prices in relation to the quantities of goods, whereas demand is the opposite. So the relationship of prices and the corresponding qualities that buyers are willing to purchase. So supply is all about sellers willing to sell, and demand is about buyers willing to purchase. So, like you can see in this chart, the trade is going to occur right at the middle point. So the lowest price that a seller is willing to sell their stock for. All right. And now purchasing stocks. So we already know that investors buy and trade stocks, and they do this through brokers because there are limited seats at stock exchanges. So what does a broker do? A broker is going to work for a client and deposit cash or stocks into a brokerage account. So the broker is going to work for a client, possibly advise them, and help them make the best decision for their future given the investments that they're interested in making. And there are 5 steps for executing a stock purchase. So the broker will execute the trade for you. The first thing you need to do is to open a brokerage account with a stockbroker. You're going to be researching stocks, renewing all of those equations that we learned earlier, the book value, the EPS, the PE ratio, and the beta. And once you've done that, you'll need to tell your broker what you want to do, including the price. So you can tell your broker, I want to buy a stock in Apple as long as I'm not paying above X amount of dollars. So you can tell them a price, you can tell them the market or the limit order. The broker is then going to execute the order for you. They're going to make a commission, whether that be a fee or a percentage of your investment. And then you'll need to stay up to date on the market. So continue doing research, making sure you are watching how your stocks are doing, and then going back up to steps 2 and 3 to continue interacting with your broker and making future investments. Those are going to be the 5 steps to executing a stock purchase. And then the last box. What do these 2 terms differ, or how do these 2 terms differ? So, a market order is going to be when you buy a stock at a prevailing price. So whatever the stock is selling for at that moment. Or you can set a limit order. So that's when you request that your stockbroker buy a stock at a specific price. So in order to achieve the limit order, the stockbroker may need to wait and wait a couple months and buy your stock then whenever it is at the specific price that you wanted it to be, based on that company's history. So that's going to be the difference. The market order is whenever you're buying it just at whatever the price the market says that it is valued at, or the limit order is waiting it out and buying it at a specific price.